Today, folks, we're talking about my best performing dividend stock of 2022, which has some incredibly large catalysts coming up that will dictate the performance of this stock, which many of you OG subscribers know. I'm not talking about an individual position. In fact, this is an ETF. And taking a look at my portfolio, of course, we're talking about VDY, the Vanguard Canadian High Dividend Yield ETF, which currently makes up 34.3% of my entire portfolio. I have over $130,000 just in this one ETF, and some major components are going to have some earnings cycles at the very end of this month, which will completely dictate the direction this goes in, because VDY is currently up or down 1% on the year, but you tap on the dividend if you bought it at the beginning of this year, which is around 3.8 to 4%, you would actually be up a couple percent finally on this year. But again, that doesn't mean it's going to continue to go this way. And just kind of comparing it before we break down the component stuff, my other dividend ETFs like VYM, which is only down 1.71%, tap on the 3% yield. And as well, you'd probably be green for the year on this one. And SCHD, the Schwab US Dividend Equity ETF, which is the worst performer of the bunch, down 4.45%. And most of the performance specifically with VYM and VDY is coming kind of from the energy sector. It's what's really stabilizing the performance, because VDY specifically, what I want to talk about here are these bank earnings. I mean, Royal Bank makes up 13% of this entire ETF, Toronto Dominion Bank 12%, Bank of Montreal 6%, BNS, Bank of Nova Scotia 6%, you got Canadian Imperial down at the bottom, and all of these large weighted financial stocks are being cushioned from things like Enbridge, Canadian Natural Resources, and energy I think will continue to stabilize this ETF, but because, financials are 50+% of this entire portfolio, energy will not stabilize it if earnings come in really bad. So taking a look at these individual stocks, Royal Bank, guys, currently yielding 3.86%, crushing it on a 5-year. Year to date is down 3.17%, is posting earnings November 30th. You got Toronto Dominion Bank here, guys, again, 5-year performance, a little underperforming Royal Bank, but again, Royal Bank is the largest, largest company in Canada. So it sits at the top of all the ETFs. So when people buy these ETFs, that money naturally flows into Royal Bank, giving it much more stabilized performance. Year to date, Toronto Dominion is down 9.8% with almost a 4% dividend yield. Earnings are December 1st. Canadian Imperial Bank, the largest exposed stock to mortgages, basically. So this one's seeing a bit of a hit in the Canadian real estate market. No surprises, trading down pretty much the worst, having some of the worst 5-year performance, but you're talking about a 5% starting dividend yield here with earnings coming up December 1st. Bank of Montreal, largely exposed to the oil sector, which is what hit it so bad in the 2020 crash here, but paying a 4.25% dividend yield, and year to date, guys, is only down 7% with a great 5-year performance, is posting earnings December 1st. Bank of Nova Scotia, again, almost a 6% dividend, one of the worst performers of the bunch, year to date, trading down 23% with earnings November 29th. And then comparing that performance to the US banks, which I'd argue aren't nearly as resilient, as none of these Canadian banks cut their dividends through the 2020 crash. They survived the '08 crisis and did much more resiliently than the US banks. But JP Morgan, after posting its Q3 numbers, bolstered to the upside pretty dramatically. I mean, the thing jumped up 27%, but 5-year performance pretty good at a 35% return. Take a look at the year to date here, down 17%. Taking a look at Bank of America, guys, this one's actually been really resilient, up 40% on the last 5 years. Year to date, trading down about 19%. But again, after all of these posted earnings, guys, they are bolstering to the upside because people are realizing that, yeah, they're going to get hit on some of the mortgages they've loaned out, some of the variable rate mortgages, but people are going to be using line of credits. Anybody taking on a new mortgage, they're going to be paying a much higher interest rate, and inevitably that is going to greatly benefit these banks. So take a look at Wells Fargo here. This one, again, probably the worst performer of the US large cap banks, trading down 7% year to date, but still rallying off the low since the recent earnings. Now, one of the double-edged swords, a piece of data that is actually a little bit, largely concerning, is the fact that we're finally starting to see savings rates fall off, and we're starting to see credit card balances outstanding hit a record high in the US. This data, though, says, hey, the banks are going to be making a lot of money off this credit card balances, is really concerning for the fundamentals of the actual economy itself. When savings rates continue to go down, people spending a lot more and having to utilize credit cards, I don't know what that's actually going to say for the rest of the market. You can't take this data and say there's a one-for-one correlation that we're going to continue to see some kind of a market correction, but this does say, the banks are going to benefit off the credit card use, but are we going to start seeing a collapse in the amount of people that can't make credit card payments? Some of the delinquency ratings, I wouldn't be surprised if we start seeing those rise, and we're going to start to see how this balance out. But once we get through this shock, whether it takes 3, 6, 12 months, so long long as we stay in a higher interest rated environment, the banks will inevitably benefit. But again, a lot of that could be speculative in nature, right? And just taking a look at the broader markets today here, guys, I am still kind of shocked at how well the S&P's performed, even though we're seeing Tesla down 5% today. We're starting to see a lot of the index start to recover here, like even VOO, even though it slightly went to the downside on the start of the day, is still relatively flat. So this performance is pretty incredible considering crypto's still collapsing. We're starting to see the full fallout effects of that. Specifically in the Canadian economy, I think is where most of the resiliency has been for my portfolio specifically, because obviously the S&P is still down like 15+% on the year. A lot of the Canadian tech companies have got hit like Shopify, but fortunately, most of the Canadian indexes, Shopify is like the only real big tech company here in Canada. It used to be the largest company in Canada until it got wiped out. But take a look, guys, because I want to pass this question off to you. Where do you think the Canadian banks are going? Are there other dividend stocks outside of energy and financials that you think are going to perform very well? I want to know what your best performing dividend stocks are here in 2022 so we can start getting a framework for what could perform very well through 2023. I'd love to hear about it, but stay cool, stay awesome, and as always, I'll catch you in the next one.